Dear students and working accountants, welcome to my Smart Tally Prep Class YouTube channel. And yesterday, in the last class, we discussed about the ledger, that is, posting the journal entries into the ledger. And at the end of the particular period, it is a month or a week or whatever, or whenever you want, balance in the ledger. That means finding out the balance. The balance means you have to total on the higher side and write the difference on the lower side as the balance carried down. That is balance you found. That is taken down to the next period. So in the next period, it is called as brought from the previous period. So it's called balance brought down. So that we get. So till that we have. In this today's day number 4, and today we will discuss a little more about the opening balances in the ledger, and we'll go to the next topic. Okay, so prayer to 4, and before that, I request all the person, students and the accountants, please subscribe my channel and click the bell icon besides that and select all, so that you will get every video before, every video by way of notification. So half an hour before the video is coming online, you will get a notification about the video. So don't forget to subscribe and that. And also you share with all your friends, that is who want to learn accounting, as well as who want to enter into accounting field, all these things. And then when you are watching the videos, every video you watch till the end. So if you don't watch till the end, you will miss, if you skip the video, you will miss a lot of information and about the topic. What the topic? Every video we discuss one topic. So you will lose a lot of information about the topic. So watch the video till the end and you like every video, because if it is okay, if the video is good, then you like the video, because it is very important. Liking the video is also very important, like subscribing to the channel. Okay. Now we will enter into the subject. We will enter into the subject and we will share the screen. See, in day 3, we discussed about the pro forma of the ledger and how the journal, debit credit is entered in the ledger. On the debit side, any account, maybe debit or credit in the journal, that is in the transaction. So credit means, debit means, you write on the debit side, we start with 2 and write the credit account name, and any account is credit means, you have write on the credit side, start with buy and write the debit account name. So in this case, in the journal, we have learned either purchase account debit, Ramya credit account credit. So debit, credit, or we write the data or data. Mostly we are learning now debit and credit. So this debit and credit, you have to remember well. And your debit means debit account, credit means credit account. So you have to remember this. This is one item and one more item. In the ledger, on the debit side, we write 2 and credit name, credit account name. That means we start with 2 on the debit side and we write the credit name. So 2 means credit account. And on the credit side, we start with buy and we write the debit account name. That means buy means debit account. So you remember these 2 things, 2 and buy. 2 means you write the credit account. 2 means credit account, buy means debit account. These 2 topics, these 2 items, ER and CR, credit and debit, and 2 and buy. These 2 are very important while we enter the tally, because in the tally we use these things. Either DR, anyone we use, either DRCR, that is debit credit, or 2 buy. By default, it will be 2 and buy in the software. So we can use it as it is, we can continue, or we can change it to without 2 and buy. Maybe you may have some little confusion. So we, instead of this, we can use debit credit. Then we have to change that. It will debit by default, it will use 2 buy. So we can change it to debit and credit. That's something you have to change. That we will learn there. We will learn in tally. So up to now, I think you are all well versed with this ledger. And now in this ledger, the problem in my example, I told about the closing balancing the ledgers, and in the account at the beginning of the period there is some balance that is ready. So we will now discuss about that is called opening balance. This is called at the end, it is called closing balance at the end of the time. And at the beginning of the period, it is called opening balance brought from the previous period. That we will learn. Okay. So when therefore see when you are opening an account or you are dealing with an account, so in the organization there will be many accounts. In many accounts, in some of the accounts may have balances and some of the accounts may not have balances. When you are starting the account in a particular period, if there is any balance in the previous period, that is to be brought down, that is to be entered at the beginning of the period, this time in the current period. The current period, at the beginning, we have to take the balance from the previous period. That is called the opening balance. So if there are any opening balances, account will be there because many accounts will continue for the whole year. But at the beginning, every month we balance or every month or every week we do. When you are dealing with the account, so the opening balance is very important, brought from the previous period. So if there is any balance in the previous period, that is to be brought in the current period. If it is a debit balance, on the debit side you have right to balance brought down. To balance brought down. Debit balance, debit side is again in the previous period. So it's called debit balance. So on the debit side, to balance brought down you have right. Suppose if the account shows a credit balance, so on the credit side, you write balance brought down. You remember these two things. Okay. So with this, we have to start. See, in the case of an existing company or organization, there will be some balances brought forward from the end of the last period. In such cases, while opening the ledger accounts at the beginning of the ledger account in the current period, on the first day of the period, that is in the current period, we have to show the opening balance as to balance brought down if it is debit balance, or by balance brought down if it is a credit balance. So after entering the opening balance only, then we have to proceed to record the transactions of the current period. Then only we have to record. For example, when bank account is there, so bank account always mostly shows a debit balance. So at the beginning of the period, so we have to write the two balance brought down, the balance of the last month or last period in the on the debit side. Then the transactions of this period, they have to be entered afterwards, after entering the opening balance. For example, after that, on the first day itself, we received some cash. So after writing the balance brought down, opening balance, then we write two. So where we received? We received from X. So 2X account, or 2 sales, that amount. Like that, we have to get for the whole period. At the end of the period, again, it's the same procedure. We have to balance the account, find out the difference, right on the lesser side, so as to tally both the sides and bring down to the next period. So the balance carried down, and at the end of the period, and balance brought down to be taken to the beginning of the next period. Okay, so this is about the opening balances. If there is balance. If in an account there is no balance, we need not take any balance. Just continue to record the transactions on the current period. So this is about the opening balances. Okay. And now another important topic. This is actually we are not going to learn. Just we have to know about that. That's all, because that's we are not using, and the bank in the tally automatically they will be created. Okay. Now you see after we learned about the journal ledger. So journal we pass the entries, that is deciding debit and credit and writing that which account is debited and which account is credited. It is the work of the journal. That's it. And after that, every account you have to post it to the particular account in the ledger. That is debit account in the journal. In the debit account you have write on the debit side, in the credit account on the write on the credit side with the particular amount. So like that we have to enter the transactions and then balance the ledgers. Okay, journal ledger. First step is journal, second step is ledger. Book of primary entry, book of secondary entry. That we completed. Okay, and after that, one major thing is ledger is only one and only one. Okay, but in the case of journal, so we are recording the transactions like debit and credit. So here in the journal, we have to enter all the transactions. So each and every transaction we have to enter in the journal. So if you do like that, so the journal will be very large, it will be a very huge book, because each and every transaction you enter in the journal, the book will be heavy. That is why what we do is in the case of this is all in the case of manual accounting. In the case of manual accounting, in this case, we will analyze the nature of the transactions. Purchases we made, cash payments we made, cash amount received, purchases we made, sales we made, purchase returns are there, sales returns are there, we paid expenses are these, expenses incomes all comes under cash payment or cash receipt. So all we are doing all these things. So these are the nature of the transactions. So depending on the nature of the transactions, instead of writing all the transactions in one journal, we separate and we maintain a separate journal for each type of a bank, each nature of transaction. For purchases, we keep a separate journal. For cash, we keep a separate journal. For sales, we keep a separate journal. For returns, we keep a separate journal. Purchase return separate, sales return separate. And for petty cash, there is one. So in the case of some companies, they never pay any cash, receive any cash. They deal with the payments and receipts only to the bank. And also, even if they are paying cash, very small amounts, everything they cannot pay. That's why they will maintain a separate book and maintain a person. The person is called petty cashier. All the petty expenses, yes, small expenses, he will look after. So he will take some money from the cashier, he will take the money from the head cashier is called. From the head cashier, he will take the money and he will pay the small expenses, petty expenses every month, every week or every month. And at the end of the period, so he will set up the balance, and the balance is there, means remaining amount is spent. So the head cashier will reimburse the spent amount. Suppose 1,000 rupees is given as a petty, that is called the interest system. Interest cash, you will do 1,000 rupees. For example, at the end of the month, there is 100 rupees balance, means 900 rupees paid expenses. So the head cashier will reimburse 900 rupees. The balance, total balance will be at the beginning, like that. So the balance will be 1,000. So this system is called reimbursement of the expenses paid. That is called interest system of petty cash. Interest system. Interest means reimbursement. Sometimes instead of reimbursing the amount, every month fixed amount they will pay. 1,000 rupees this month. Whatever is spent and whatever is the balance. Again next month again 1,000 rupees. That is ordinary system. This is interest system. So like that, 150 cash we will enter. And every day expenses we will enter in the petty cash only. We will not enter the ledger. And all these petty books, in these books we enter the transactions, and at the end of the month, the total amount we will enter in the concern account. Some accounts we will enter in the, every day we will enter individually. And from the total of these books will be entered at the end of the month. So this actually not required. I will tell you, this is called these journals are called subsidiary journals or subsidiary books, because we are maintaining many journals. All these are called subsidiary journals, or they are called subsidiary books. Okay, so we'll find out one of them. See, after learning about this one, we will have another topic called subsidiary books. Subsidiary books means separate journals maintained for recording each type of transaction, depending on the nature. These subsidiary books are used mainly in manual accounting system only. So these subsidiary books will be as follows. These are the subsidiary books. First one is main one is cash book. So for cash receipts and cash payments, we maintain a book. It is called cash book. This cash book is nothing but a cash. We maintain a separate book for that. The ledger will not maintain cash account. In the ledger we will not maintain cash account. We maintain the cash book. The cash book itself is cash account. So all the receipts will be entered on the debit side. Whenever cash is received, whenever cash is paid, we write on the credit side. We perform will be as same as account, that is cash account. Debit, credit, divided into two parts. Debit side, date, plus amount. Credit side, date, plus amount. And general folio will be there, that is never used. Okay. Like that, we enter in the cash book, all the cash transactions. Whenever cash is received, cash book is debited. Whenever cash is paid, cash book is credited. So, and sometimes we pay cash into the, cash transactions, along with cash transactions, there will be some bank transactions also. Bank transactions also, the transactions will be carried on through bank, but it is also cash transaction. We paid amount through bank to somebody, that is, we should have checked. That means, on our behalf, the bank will pay to that person from our money. Bank will not pay its money. It will pay from our money. So it means, if it is paid to someone on our behalf, it means it is paid to us only. That means it is nothing but we have taken the money. Taking the money, giving to the other person. Instead of that, the bank will pay directly to the other person. Okay, so these payments and receipts when you got receive, when you receive any check, so directly you will deposit in the bank. It will collect from the other person. Sometimes the customers also directly they will deposit in our account because they are also having the account in the same bank. From their account, they will transfer to our account. That means they pay directly to the bank. It means they pay to us, we pay to the bank. It is like that. On our behalf, it is taking the money. It is nothing but our money paid into bank. So for this purpose, instead of maintaining bank account also in the ledger, that also they will not maintain ledger in the ledger. They will maintain another column in the cash book. In the cash book, debit credit side they are writing. They will put another column, cash column one column and bank column. So bank transactions also will be recorded along with cash transactions. Whenever you receive from bank account debit is received and paid into bank. Whenever you receive a check, you will not keep it. That is paid into bank. Deposit into bank. So that is debited. Bank account debit to X and O we receive from them. But we enter the amount in the bank column. So bank transactions we enter the bank column. Cash transactions we enter the cash column. On both sides, receipts and payments. But there is one peculiar item in this. Suppose if from the business, if you have cash balance is more, so instead of keeping that, we will get the so we will give some amount and X amount will pay into bank. So cash deposit from the business into the bank. One. Another one. Cash received from bank, because suppose if you don't have money, you want urgent expenditure, you want money, then we go to the bank, we will withdraw, self-withdrawal, we will withdraw money for the business. So paying money from the business into bank and for the business withdrawing the money from the bank. Okay, and another one, suppose we have two accounts. One account, there are balances. In one account, there is very little amount balance is there. So we require some balance. So from this account, one account to two account, we transfer the money. And sometimes we have another account in another bank. From this bank account, you can transfer to the bank account in the other bank. So that also. So it is also like depositing bank, transferring from one account, withdrawing from one account and paying into the another account. It is nothing. It is also entered here. In this case, deposit into bank or withdrawal from the bank or transfer from one account to another account. The same bank, another bank. Transfer from one account to another account. They are also entered in this cash book. Then in that case, how do you enter? In the case, suppose if you have two accounts, cash column we are writing, bank account column we are writing, but for bank, we write bank one, bank two columns we write. Because with respect to bank only, we have to enter the amount. Okay, that is why what we do is bank one, bank two, like that we enter. In the same bank or another bank also. Another bank also, if we have account, this is one bank account, this is bank one account, bank column one, another column is bank column two. Like that we maintain. In this case, how do you enter these type of transactions? Transactions between the business and the outsiders that we know. If the transaction between the business and the bank, then how to do it? Because we deposited cash from the business into the bank. In that case, what is the actual entry? What is the actual entry? Cash is going out. Cash account is to be credited. We are paying into bank. Bank is disabled. Bank account is to be debited. Bank account debit, cash not debit. But here, both bank account here is cash this account. So cash account is to be debited. Bank account is to be credited. Bank account is to be debited. Cash account is to be credited because we are paying into bank. In this case, both these accounts are in the cash book itself in the shape of two columns. This bank cash book is called two columns are the cash book. Simple cash book is called simply cash book. If you have two columns, it is the cash and bank columns. Cash book with bank and cash and bank columns, we say, or the cash book with two columns. That is two columns of the cash book in this case. So bank account we have to debit and cash account we have to credit. So what we do? So debit on the debit side, we write to cash, isn't it? Where you are paying into the bank. Bank account is to be debited. So on the debit side, in the bank account, what you are paying? Cash you are paying. On the debit side to cash account, we write in the bank column. So credit is to be done in the cash account. Yes, cash column. In the cash column, we have to credit because cash is going out. On the credit side, we write by where you paid to bank. By bank account, we write in the cash column. So one side we write in the bank column, and another side we write in the cash column. Similarly, when you withdraw money from the bank, cash is coming in. So cash account is to be debited. So cash column, we write on the debit side to bank account. Bank column, we write on the credit side. Bank column is bank account. Bank column, we write on the credit side by cash account. So we are writing both debit and credit in the same book, but in different columns. This type of transactions recording is called contra entry because both are recording here only on the opposite side. One is debited, one is credited in different columns, not in the same column. Remember, cash debit, cash credit, right? Cash debit, bank credit, cash credit, bank debit. So the different and the others opposite side, both the sides we are writing, but in different columns. This is called we call it as contra entries. In that case, we write journal folio column is there. We don't use it for journal folio. In that case, we write as contra within brackets in the column. We write C. C means contra. Both the sides. Cash book debit, bank credit. Cash book debit side, cash column. Before the cash column, there will be this column. We write credit. On the bank column, credit side, we write credit. I mean C. C means contra. Contra entries we are writing on the both sides. This is the about cash book. And sometimes when you are receiving money, either cash or through bank, when you are paying money, either cash or by check, you are paying. There will be some discount. When you receive money, we may allow some discount. When you pay money to the creditors, we may get some, discount received. In that case, so along with cash or bank, there is discount account also. So instead of that, the discount account, we write a separate column for that. But remember, cash column is cash account, bank column is bank account. We don't maintain bank account and cash account again in the ledger separately. This is treated as bank account and cash account. But this discount column is only a discount column. It is not account. It is not account. So we write on this. For example, we received money, cash or bank. We received 5,000 rupees is the balance. In that there is 5% discount. Means 25 rupees. Isn't it? What is 10%? 5,000 means 10% is 500. Out of that 2.5 50% means 100. Sorry, 5,000 means 500 to 50. 250 rupees is the discount 5%. So on the debit side, we are receiving money to X and O. We received in the cash column, if we received cash. In the bank column, if we receive check, we write in the respective column, we write the amount received. So it is 5,000. 250 is the discount is 4,750 we receive. So cash column or bank column we receive 4,750 we write. And this 250 rupees in the discount column we write. Okay, like this we write on the debit side and credit side. And at the end of the month, these cash and bank columns only will be balance carried out, balance model. But discount column on the debit side we total, on the credit side we total. The total amount is entered in the discount account in the ledger. We maintain the discount account. On the debit side total we take two sundry because this discount is received not from one person, from many persons. So from the persons we already entered. So it is called two. If it is a single transaction, we to X and Co. Receive discount from X and Co. But allow discount to X and Co. If it is debit. Here we allow discount to different people. That is the total for the whole month. Total of different transactions. So we write 2 sundries. To sundries, suppose it is 1,500 rupees for the whole month. So to sundries, 1,500 rupees. That is for the whole month. This is discount allowed. Suppose if we did not discount received on the credit side, that will be total. A discount received account we are writing. This is discount allowed account. And discount received account we maintain the ledger. There we read on the credit side by sundries 1,000 rupees something like that. So that will be posted in the ledger at the end of the month. You take the total. Okay. So this is about the cash book. This is called 3-column cash book with discount. So this is called the cash book, simple cash book, 2-column cash book, 3-column cash book. Okay, there will be no 4 columns or 3 columns. This is cash book. This is the most important subsidiary book. Then second one, purchases book. That means purchase book, sales book, purchase returns book, sales returns book. Then I said petty cash book, separate the petty cash here. We will maintain a separate book. Petty cash book, we will write the small expenses in the book only. In that book we will write. And at the month, every expenditure will be total. Every expense separate column you will write. You will be knowing in become and enter petty cash book. So we will analyze the transaction. We write the amounts in the respective column. Printing and stationery 1 column. Postage, telegrams 1 column. Like that. Office expenses 1 column. All these columns will be total. And each total amount, each column amount total will be posted in the respective account in the ledger. That is all expenses only. So on the debit side, we write to sundries. For example, printing and stationery to sundries. Printing and stationery, postage and telegrams to sundries. We post in the ledger. And this purchases and sales, purchase return, sales return. Here, in the purchase book, it is not any account. It is not any account. All these are not accounts. Only statements like and purchase book we write is a book register we also call purchase book or purchase tally which is called purchase register. So purchase book or purchase register, sales register like that. This book we enter the particulars and the amount. And particulars mean the particulars from where you purchase, from where you purchase, from the particular person. To by you never use it is not an account. They are simply in the date column. You write the date in the particulars column, X and O. That means you purchase from X and O amount. Right? So we write in this journal. And actually, for every transaction, there will be 2 accounts you have to pay. This is only a statement. So it is not, it is a register. That means then both 2 accounts, debit and credit, will be entered in the ledger. But every day, you will not enter in the ledger, both the accounts, the individual accounts. So purchase from party, sold to a party. So the party account, we have to know every day what is the balance. That is why that is to be posted immediately. Only in the party account, we post immediately. For example, in the purchase register, we write X and O 5,000. Immediately in the X and O, we purchase means is a creditor. In the X and O, we enter on the credit side by purchases today. On this date, by purchases 5,000. That's all. But in the purchase account, we are not. Only in the individual accounts only, we enter for purchase book, sales book, purchase book, sales book. We enter. And at the end of the period, we take the total. The total amount will be posted in the respective account. For purchases book, there will be purchase in the account. So purchase account we enter at the end of the month, the total of the purchase for the whole month. So purchase account debit, and the debit side to sundries, purchase from different bank. What is already posted on the same day. And in the purchase account, we post at the end of the period only, taking the total. Like that, we write the purchase book, sales book, purchase book, sales book. And petty. Petty cash expenses also we never post. And the cash is already taken. Cash account, main cashier will pay him, he will show as received and expenses paid. And he will balance that and he will take the balance. And all this okay. And last one is general account. So we are writing the transactions in this call book, in the subsidiary books, depending on the nature of the transaction. Okay, but if you cannot enter in all these books, any book, you cannot enter in any of the books, then write to it. For example, I purchased furniture on credit. You cannot enter the purchase book. Purchase book. What is meant by purchase book? Purchase of goods only. Purchase of goods only. So in the purchase book, we should not enter. But it is purchased on credit. So do you pay cash? No. We are not paying cash. So we cannot enter the cash book. So we cannot enter the cash book. We cannot enter the purchase book. isn't it? It is not returned. So purchase returns we cannot enter. So we cannot enter in any of the above books. Purchase of assets we cannot enter in any of them. Then what to do? For that, go. We read original journal. We are dividing. We are maintaining many subsidiary journals. But if you cannot enter in that, in the original journal only you have to enter. Definitely. So in such case, this is one of the subsidiary book now. Previously, journal is one book. All the transactions will be recorded in that. It is called journal. But here, now, it is one of the subsidiary books. Along with others, this is also one of the journal. I mean, one of the subsidiary book. That is why this is called here, not journal. It is called journal proper. That is, journal is the only one book recording all the transactions. Journal proper is recording only the transactions which cannot be entered in the other subsidiary books. So this is also one of the subsidiary books. So here, so all these we need not learn now because tally price it will automatically create all these purchase book. They are registering create in the name of a purchase register, sales register, purchase returns book register, sales register. But this purchase returns and sales register can be maintained in tally in two ways. That you can learn in while learning the tally. Okay, so these are the books. So these books are automatically created in tally term, hence we can learn them in tally frame directly in detail. Okay, understand now? So if you have any doubts, or you can go through again, you can watch the video and you can also you can or if you face any problem or even though you see many times you cannot understand, then you post your problem or anything about any of your doubts, you can post in the post in the comment section in the video. I can see, I can understand, I can clarify that in the later stage. Okay. And now what we did, we entered all the transactions in the journal. That is one journal or subsidiary books are also journal. So we entered in the journals, then posted into ledger, and after posting into the ledger, whether we in the ledger, we're taking over balance, recording all the transactions, and the ledger is balanced. So if the ledger means all the accounts in the ledger are balanced. When you balance the ledger accounts, some accounts will show balance, some accounts will not show balance. Some accounts will not show balance. Suppose we purchase goods from a person, his account will be a credit balance. He is a credit account. Suppose you paid the total amount. You paid the total amount. So amount is paid means his account is debited. So credit we purchased, debit we paid. So balance will be zero. So there will be no balance. Like that, there will be some accounts will show balances, some accounts will not show balances, and in this case also, some will show debit balances, some will show credit balances. All the debit balances should be equal to the total of the credit balances because some are not showing balance because debit and credit same close, and others also even though they are showing the balance. What is the balance difference between debit and credit? So difference instead of taking total debits, total credits, then the total will be same. If you take the difference also, the total will be same. Debit side you are taking the totals, and the credit side you are taking the balances only. Then both the balances, okay, debit balance and credit balance, that it will be equal. So for these, we prepare a statement, list of the accounts, all the accounts which are showing balances. So those list we will enter in a statement or in a list. That list of accounts showing balances only. If there is no balance, we will not take. So all the balance, all the accounts with balance, they will be shown in one list. That list is called trial balance. The list is called trial balance. So in this trial balance, we take all the accounts with balance, and if the account is not showing any balance, we will not show them. See, after posting all the journal entries into ledger, some ledger accounts will show balances, and some accounts will not show any balance. In all this, then all the accounts showing balances only will be listed at one place with debit balance and credit balance separately. This list of accounts is called trial balance. The total of trial balance on both the debit and the credit side should be equal. Since we debit one or more accounts and create one or more accounts, the debit and credit will be same. That is why this balance sheet, in trial balance also will carry it will the balances total amount. Debit side and credit side should be equal. Otherwise, if it is not equal, it indicates that there is some error. The error may be while recording in the journal, or it is correct while recording in the posting in the ledger. That is also correct while balancing the ledger. You did a mistake. That also correct. Everything is okay. But while taking the balances into the journal, suppose there is a debit balance in one account. By mistake, we entered on the credit side in the trade balance. It's an error. So whatever it may be, definitely there is an error. Then we have to check up all the errors. Okay. Now, the trial balance, how the trial balance will look? It's only a statement. Okay, here we got trial balance, we will writing at the trial balance. Remove this above balancing. Okay, you write the pro forma will be, right? You write the name of the accounts and debit balance. There is debit balance, debit side, and there is credit balance, credit side. That's all. Only 3 columns. You write what plus 1 column, that is name of the accounts with balance, and one is debit amount, credit amount. So we have to know what are the accounts which show debit balance, what are the accounts showing credit balance, right on the respective side. So this, and this tail balance is taken on a particular day because the previous day the amounts will be different. Today some transactions take place, so the balances will change. And tomorrow again there will be some transaction, the balance will change. The balances will change. That is why the balances on a particular date. What are the balances? Yesterday, the balance was not maybe different. Tomorrow, the balances may be different. That is why on a particular date, what are the balances we are taking? That is why it is called as writing as trial balance on so and so date. Okay, it is we are writing as trial balance as on 31st March 22. On the date, this is that are the balances. Then we take it on the last day of the year. We prepare the trade balance, and further we go on the basis of journal, we are preparing ledger. On the basis of ledger balances, we are preparing trade balance. On the basis of trade balance, we go further for final statements. We go further we prepare the final statements. Okay. Then see here, trade balance as on 31st March 22. What plus name of the accounts, date amount, credit amount. Capital means the proprietor introduced the amount to the business. He gave the business. He is a creditor. Instead of his name, write it as capital. When he is giving the amount, any amount to the business, we write it in capital. When he is taking from the business anything for personal use, we are writing in drawings account. He is the receiver then. Drawings account will be a debit balance. It will show a debit balance. Okay. Now, then creditors. All the creditors will show a credit balance. So each individual person will write in that trade balance. We write the individual accounts, X account, Y account, Z account. But here I am writing so the total amount, that is all the creditors collectively they are called sundry creditors. Individual is a creditor. Each individual is a creditor. All the creditors collectively called sundry creditors. So this is the amount C, capital credit. Sundry creditors also credit. So for example, this is the total amount. Then land and building, it is an asset. Asset means debit what comes in. So it is with us. That means it is a debit balance. It is with us means unless it is sold out, it is with us. So the debit will be as it is. So land and buildings, debit balance. Then unsecured loan from Venkat. From Venkat, we have taken loan, unsecured loan. What is secured or unsecured? We have taken a loan. It is a liability to us because he is a creditor. So here, he is also creditor and the syndicate also there. The syndicate means related to the business goods. So from whom we purchase the goods, they are called syndicate. He is also a creditor, but he is not a business creditor. We have taken loan from him. So it is written separately. Loan from Venkat. Not as he is also creditor, trade balance. But we don't it as syndicate. We not include. Because syndicate means who sold goods to us. You remember that. Then syndicate means when they are purchasing goods, they are syndicate. When they are selling goods, they are debtor to us. So each individual A, B, C, D, or X, Y, Z. We write all the individual debtors accounts. They are collectively called sundry debtors, like creditors. They are called sundry debtors. But in the trail balance, all the ledger accounts, that is, each debtor account, you take separately. Okay, and then stock on hand. The stock on hand is also called closing stock. Closing stock. So closing stock of last year will come to the present year as opening. We can't as that. So stock on hand is closing stock of last year or opening stock of this year, the current year. So this is called stock on hand. This is the opening balance. So it will be as it is. So it will be a debit, which is an asset. Okay. So this will be clear. And closing balance of this year, that will not be shown in the balance sheet. It will not be shown in the balance sheet. It is not shown in the trail balance. That we will calculate, verify the balance, what is the different items, stock items, the total, what is the stock on hand. We take it this year at the end of the year. Then we make entry, adjustment entry to stock. So then that will be made in general profit. If it is entry is made, we are right. Entry made means we are right both debit and credit. So debit and credit will be entered in the final accounts directly. And in the next year books, this balance will be again opening balance. It will come in the next year books at the beginning of the year as stock on hand, or it is also called opening balance. Next year, this year closing balance. Next year opening balance. Okay. Next, Indian Bank OD. Indian Bank account we have, but we have OD there. Overdraft. Overdraft means we can withdraw money more than our balance. Then we have to pay to the bank. So it's a creditor to us. That's why it is a separate account. Simply some State Bank of India account means either in the case of individuals, it is savings account. In the case of business, it is only current account. Only simply savings bank account. And State Bank of India means. But other types of CC account, OD account, all this we write with the nature. So Indian Bank OD account, loan from bank, or similarly loan from OD, loan from Indian Bank. It is separate. All this will be entered separately. Separate accounts are to be maintained. So Indian Bank OD account, it is credit because it's a creditor. Bank is a creditor. Creditor a credit side. Plant and machinery asset. Computer and printer is asset. Cash balance we have at the end of the year. Cash book will have some balance. Cash book account, cash account is nothing but cash account. Cash book will have some balance. That balance will be on the debit side only. So cash account, cash balance, and then State Bank. Just I simply gave current account. Simply State Bank account means it is current account only. In the case of business, it is current account only. You know, to just to make you understand, I have given you current account. State Bank current account. So these are all the balances. Debtors and creditors we will write here all the individual accounts, but I taken the total here. Andasa, approximately. So the total amount is 11 lakhs 746 on both the sides. If it does not tally, means there is some mistake. See, from beginning you should not come to check up from back, you have to go for backwards because this is the end of the last one is taking from the ledger into the trail balance. If there is a mistake here, instead of going from journal, searching all the books, you say this. Here if you check up, if it is correct, then go to the previous stage. The every step, from last step to first step, you go backwards to check up. If it is found, the error is found, we need not go to the previous steps. Like this, we have to check up and we have to rectify that, and then we have to make the tail balance tally. If it is tallying means we assume this is correct, but actually even if it is tallied, there may be errors because one account error in one account with the same amount, error on the opposite side in another account, it will compensate. In one account on the debit side you wrote 100 rupees less. In another account on the credit side you wrote 100 rupees less. Both will compensate, but there will be no effect on the balance. So you cannot say books are correct. So this trade balance, tallying of the trade balance is not a conclusive proof. Here you see, trial balance is a conclusive proof of correctness of accounts. This is the statement, general statement. But this statement is not always correct. Not always correct. There will be errors. Still the trial balance will tell. Because An error on debit side may compensate another error on the credit side with the same amount, or in the same side with X amount in one account, lesser amount, short amount in another. In the same side, in one account we entered 100 rupees less, in another account we entered rupees more on the same side. Opposite side is this side lesser and that side also we entered less. In this one account excess, one account short. In that case also, the trial balance will be added. That is the thing. So this trial balance will be added, though it is not correct. We cannot say the books are correct. There may be errors. Suppose there are errors like that, in the computer accounting, simply we alter change it. But in manual accounting, we cannot erase or we cannot overwrite, we cannot make alterations. In such case, if errors are there, these errors have to be rectified by writing another entry. By writing another entry. Instead of in your degree or intern, you will be having rectification of errors. Rectification of errors. So the errors should be rectified by giving another journal entry. You cannot erase or alter that. Okay. So with this, we have entered from stage 1 to last but one stage. Journal entered, posted into ledger, taking balances, then prepared the trial balance. On the ledger is the basis for trial balance. On the basis of trial balance, we go to prepare the final statements. These are important. Final statements, there are two statements. One is to find the results, whether we got profit or loss. The second one is to know that our financial position of the business. What are the assets we have? What are the liabilities we have? So to check out how the business is progressing, going up or going down, what are the problem, and how to rectify that, and how to increase the business, how to rectify the mistakes and all these things. This is called final accounts. Final statement of accounts, simply we call it as final accounts. So in the day 5, next day, we go to the final accounts. In the final accounts, both the parts. One is for finding out the results of the business, another is finding out the financial position of the business. These two we then day 5, and actually day 5 I start completed, but then again I added day 6 also, because till now we have entered all these things. There are many terms we came across. I told the answers, what is the meaning also, but in all these again we will take out. There is some terminology, means there are many terms used in accounting only. They are necessary and they are used either in the manual accounting or in the computer accounting, Tally Prime also, or any computer accounting. Computer accounting or manual accounting, this terminology or the accounting terms are very important. So I extended one day. So I will explain all the terminology, means different terms in the what you call different terms used in the accounting. So that will take a 6th day. So tomorrow we will take up 5th day, that is final accounts, and then the next day we take the terminology of accounting. With this we completed day 4. Okay. Now I tell you again, please subscribe to my channel, click the bell icon and select all and share with all your friends. Okay. And while watching the video, watch the video till the end. If you have any doubt, watch it again and like the video, each and every video you like. Please, this is one request from my side. And one more thing, in the last video I did not tell you. One more thing is, so I am staying in Hyderabad. So along with this, in this channel, all the videos I give all the knowledge, expert knowledge, fully, I give full knowledge, not simply like giving something and skipping something. I will, from basic to advanced, every type of cable, every topic I will touch. Now, even in the paid classes in the institutes also, they skip some chapters, some topics. Even sometimes they will give some theory part. They will tell you, they will not show in the accounting. That is in the fail exam, what is the accounting treatment for that particular topic. Like that. But I give complete knowledge in this, so you get full knowledge. Still, some people they feel taking up face-to-face offline classes or sometimes online classes in the computer itself. Suppose I am telling and explaining you. So if you have doubt, immediately you can ask and clarify. You can get clarification. For that purpose, some people they may require online classes. Some people who are staying in Hyderabad, they can attend the class like face-to-face offline classes if they want. I will conduct all these cases, but they are paid classes only, not free classes. This is completely free. Everyone till the advanced level, it is completely free. But in the classes, it is a paid class. The fees also not like institutes, other institutes. It will fees also will be very simple, very moderate fees. With that moderate fees, I will take up classes also. If anyone require any of these classes in my channel, in the about section, I have given my phone number, mobile number, and email address. You can contact me. Okay, so be safe and wish you happy learning with my channel. With my channel. Good morning. This is morning I'm making, so it is good morning and goodbye to all and meet in the next video. Okay.